Hey guys, Buddy with foxwithstocks.com. You can visit our website, foxwithstocks.com. It's still a work in progress, but you can sign up for our newsletter. And today I'll be walking you through selling a put on Open. That's Open Door. The reason I'm taking a look at this is that it's one of the companies held by ARKW. I really like Cathie Woods. I like the details and analysis and stuff that they do. Dave Lee also talked about this on his channel. And I wanted to take a look and see if this company had any good stock options going on, and we did find something. So I am going to be trading this, and I'll walk you through it in a second. Walmart, my favorite website for looking at stocks and their charts and their information and all this other good stuff. However, is not doing so good today because it does not recognize Open Door. It's still too new. I've noticed that has been a problem in the past, even though the company went public late December. It's January 8th, and they still don't have it on their website. So we won't be using that for our research today. But let's jump into this. I've already looked into the company. In the future, when I have more time, I'll show a deeper dive into the research of the company. I want to show you the trade that we're making, opening up February 19th. It's the expiration date. Open. Yeah. About 42 days to expiration. Selling the 22.50 strike because if you look over here, it's got a nice premium of $1.45. And if you do the math on that, $1.45 divided by your capital, put in 22.5, you see a return of 6.4%. Now 6.4% in 42 days is pretty good. So if we take 365 divided by 42, you get 8.69. So that's, you get 8.69 periods if you were to repeat the trade over and over again. And then we take 6.4%, which is the percentage we figured out. So if you were able to repeat this trade every 42 days, you would earn 55.6% ROI. Now, that's not going to happen, so why did I bother doing that calculation? Well, the reason I bother doing that calculation is when I'm selling puts, some are going to be 20 days out, 30 days out, 45 days out, etc., etc., etc. And so so that you can compare apples to apples, you want to convert it to APR instead of just ROI, because you want to make sure that you're getting the right calculation. Should you take 6% in 20 days, or should you take 9% in 45 days? Should you take 7.5% in 30 days? Right? You want to be able to compare those equally across the board. And the easiest way that I found is to convert it to APR. Even though you will not probably be able to make this trade over and over again and get that APR, it's mostly to just compare apples to apples. Other thing that I like about this trade, if we take 22.50 and subtract our premium of $1.45, we end up with a break-even cost of $21.05. Today it's trading, what was it, 28. Now it's spread between 27 and 28. Sorry, 27.83 and 28.11 because it's pre-market. So there's a bit of a spread here. Okay, well, let's just calculate it at 28. So we're about $7 below its current trade value, which is almost about 25%. Let's divide that by 28. Yeah, I mean, it's really, really close. So you're getting about 25% downside protection. Now, the way you notice, I subtracted our premium. Now, when other people look at this, they just go, oh, you take 28 and then you take 22.5, and that's your downside protection. But you really should be calculating with your premium. And so this tells me that even if the stock were to go down 24%, I would still be net positive on this trade. And ideally, it'll stay above 22.50 for the 42 days. But if it gets assigned to me, I don't care. Basically, I've went out and I've researched a company that I like, that is a good company, has good potential. This is a growth company. It's not a value. It's not like a value stock. It's not a blue chip stock. But this is a company that I might buy and hold long term. And so when you have that situation, if you can set up a nice put sell, then you don't care if it gets put to you, because basically it's like asking, Bud, would you be okay buying this at $21 today instead of 28? And be like, yeah, I'll buy 100 shares for 21 while it's trading at 28. And so if you're okay with that scenario, then you can sell the put in this situation. I'll make 6.4% in 42 days, or I'll own this company for 25% less. Now it does open up specifically one risk factor, which is that for 42 days you have no protection from bad news. If something happens to the CEO, yada yada, you're locked into that option. You could try and trade out of it quickly, but you might have to do so at a loss or to take very, very minimal gains. But still, that 42-day risk of bad news is much safer than buying the stock outright at 28 and having limited days for bad news. So I'm willing to do that trade. And so I use Tastyworks. I don't get much of a referral. Referral link in the video below. I like it because it's the easiest and clearest one to use. I've used Thinkorswim and Schwab and Interactive Brokers and Tastyworks, and Tastyworks is my favorite. So let's just run through this. We're selling the 2250 put. Obviously our break-even is 2105, so our max loss is 100 shares times 2105, so our max loss is $2,105. Tastyworks does let some margin go through even on the option, which is cool. My max profit on this trade is $145. So if you're a day trader, this type of non-asymmetrical risk should scare you, but day trading is not for me. It's too active. It's not investing. It's a job. It's a skill, and I respect the people that can do it, and I've done it for a profit, but I find it takes too much time, too much attention. And I think there's a lot of scam books and a lot of scam artists that pitch it. And yeah, if you're a day trader, I hope it works out for you. The reason I love selling stock options is I can go long term. I can basically trade on stocks that are good stocks. I'm not trying to find crazy chart patterns and stuff like that. I just want to show the chart, right? So I don't care what the tops are and the bottoms are and this and that, and whether we're gonna whether we've got a wedge forming for a breakout and we think it's gonna go up, and then we're starting to trade on a bad stock. I don't believe in day trading on bad stocks. I avoid bad stocks altogether. So the reason I like selling the puts is, like I said, in this trade I'll have 25% downside protection. Automatically, the platform is calculating a probability of profit of 76%. That means that the trade will expire in my favor. That means the person buying this put only has a 24% chance of making a penny or more, whereas I'm taking the other side of this trade because I'm selling the put. I'm not buying the put. Another way to say this is that I'm writing the put. I'm the one creating the put that somebody else is buying, right? So it's a contract, and they're buying my contract. Well, they're buying a contract that has a 24% chance of making a penny, whereas I'm creating the contract and collecting $145 premium up front, and I get a 76% chance based on the mathematics of the volatility and etc. of the price movement of this stock. I have a 76% chance of having that contract expire in my favor. And so I like to be on that side of things. And I consider the pop to be a lower estimate, right? This is saying that I have a 76% pop, but because of my fundamental analysis, because of my research, because I'm choosing companies that I think are going to be good for the long term, I find that I typically have about a 90% probability of profit when dealing with this type of situation. So anyway, that's how to do this trade. Put in the send order. Now that order is working. If I wanted to cancel it, I could come in here. It'll see the pending order here. You could right click and cancel. I think it's always important that when you're making trades that you know how to cancel the order. And this is just another great thing about selling put options, is that I'm doing this before the market opens. I'm putting in the orders and they get filled at, opening time, which is 9:30 Eastern Standard Time in the US. And right now, I have an hour and a half to cancel this order if I change my mind. Whereas I'm not having to sit there and click the button to buy or click the button to sell right at the moment. I'm not putting in stop loss orders. I'm not moving and trailing my orders. I'm not doing all this other stuff. I am taking my time and making my decisions and putting in my trades while the market is closed. And then until the market opens, I can cancel that order or change my mind or change my price. In fact, that is one of the things I wanted to do. I've already got one here floating at $1.45. I wanted to change this one to $1.48 to try and squeeze out a little bit more profit, if possible. So we'll see which one of those goes through, $1.48 or $1.45. That's how to do it. If you're interested, actually, I got a little document here. Just to recap it, ticker symbol is open. The company is open door. They're in the real estate sector, real estate technology. Today's price is 28. Strike is 22.5. Premium is $1.45. Expiration is February 19th, 2021. Our duration is 42 days. The ROI is 6.4%, and the APR is 55.6, just like we talked about in the video. But if you're interested in learning how to do this and and what trades I'm doing as I'm doing them, go to foxwithstocks.com. The website is going to be redesigned. It is going to be finished. It is a work in progress, but our free newsletter sign up is available. Come over here and type in your email address, and then we will send you some information and start sending you free picks so that you can trade along with us. And then once you get comfortable, you can upgrade to our premium status for $100 a month, and then you will get all of my trades directly to your email address as I am doing them. And so you can follow along and trade the easy way. All right. Thank you guys. Like and subscribe. Cheers.